All right, well, welcome back to another edition of Financial Accounting. We're going to start talking about Learning Objective 3.3 today. There's a lot to cover, so let's jump into this sucker here. Why is the first draft of the trial balance called the unadjusted trial balance? Well, put simply, you're going to notice that many accounts need to be updated. Updated, i.e., adjusted, based on certain information that has not yet been received from us. We sometimes we need to make estimations of revenues and expenses, but what you'll see is we should not record any type of financial statements, produce any financial statements until we've examined at least all the expense and revenue accounts. The process, even though there are several accounts to consider, the process starts by looking at revenues and expenses and asking ourselves, is there any expense that has been incurred that I don't quite know about? Even if I have to make an estimate, I may need to record it. Same thing with revenues. Are there any revenues that I've earned but don't know about for sure yet? I may need to make an estimation for revenues. The summary of the adjusting process requires us to do primarily two things. Like I said, measure income and then update the balance sheet. When I say income, realize I'm talking about updating revenue accounts and expense accounts. And typically when we're updating revenues, there's going to be some sort of receivable asset account that needs to be updated. When it comes to expenses, oftentimes we see that we may have to record some type of payable account, which is a liability. But there are certain circumstances where you also may have revenue that requires an update to what we'll see as a liability account. And there are certain expenses where we have to record an expense to update a specific asset account. Okay. So it's not just limited to one type of asset account for revenue or one type of liability account for expenses. There are a host of things. The key things to remember are we have to update income somehow, and that's going to require us to look at revenues expenses. When we do the updates for revenues expenses, we will affect ultimately the balance sheet accounts. So at least one, here's a key thing, at least one revenue expense account will be affected, and you'll have at least one asset liability account that will be affected. So realize that these adjusting journal entries we do at the end of the period generally don't affect cash. We'll talk about in Chapter 4 situations where we have to make an adjustment to cash when we do our bank reconciliation. For right now, when we know that there's revenue and expense that has revenue has been earned or expense has been incurred, generally means some type of asset or liability account needs to be updated. Generally, it's not cash. Realize if we forget to do these type of adjusting journal entries, net income will be wrong, any retained earnings will be wrong, the balance sheet overall will be wrong. Because why? Because these affect the income statement, and these ultimately affect the balance sheet. So we have to go through and even make a guess sometimes as to how much revenue or expense needs to be recorded. The three categories when we're talking about which types of accounts we need to look at, generally, like I said, look for things that affect revenues and expenses. We will look at situations where revenues and expenses need to be recognized for deferrals and accruals. Depreciation is primarily just expense recognition type of journal entry. So we'll take a close look at that one. I know that one causes people a little bit of frustration, but the notion of deferrals basically means we're pushing revenue expense into the future. And accruals basically means we're pulling revenues, expenses into today. Okay? And the reason why we have these is because primarily there's a timing difference between when cash moves in and out of the company and revenue expense is recognized. Because remember, we may have expenses that we need to show right now even though we haven't paid for them. That's why we have payable accounts. There may be revenues that we need to show on our income statement even though we didn't get the cash yet. So that's what a lot of these hearken to, but we have to kind of look at these in detail here. So the definition of deferral is an adjustment for payment of an item or receipt of cash in advance. So imagine we have this event, revenue or expense. Okay, it happens at time equals 1. Maybe that's 1 month from now, maybe it's tomorrow, maybe it's 1 year from now. The idea here is that this revenue expense needs to be recognized in a particular period in the future. This is the future. But if we look today, if today is time equals 0, that's today, then realize cash has potentially been received or has been paid right now. We are deferring or pushing any type of revenue or expense associated with this cash into the future. We'll look at different examples of this, but realize cash is moving now. Revenue expense is being recognized later. Definition of depreciation. Depreciation allocates the cost of a plant asset to an expense or the asset's useful life. This is kind of similar to what we just talked about. Time equals 0 today. Paid cash for, say, a computer, and in the future, say time equals 1, time equals 2, and say time equals 3, we're going to expense a portion of that long-term asset, usually evenly, over the next several periods. So even though we pay, say, $3,000 cash right now for computer equipment, we may only show, say, like 1/3 of that as an expense in the future, another 1/3, and another 1/3. Ultimately, all this cash that we pay will end up as an expense, but we may have to show that expense, say, only at 1/3 of a time each year that we use the asset. Again, we will look at examples. What's an accrual? The idea of an accrual is to bring forward any type of a recognized revenue expense right now. So revenue expense, right? We're going to go ahead and say now, instead of saying this is T1, we're going to say, let's assume this is T equals 0. This is today. We need to recognize a revenue expense today because those things have happened to us. But sometime in the future, we will have to get those settled out in cash. That's the future, right? Cash moves. So if we're talking about recognizing revenue today, we'll recognize revenue, say, on account, and we'll receive the cash later on. Maybe people have worked for us, so we'll recognize the expense today, but we'll pay out the cash in the future. So we're talking about accruals as we're taking the revenues and expenses or pulling them into today. Even though cash is moving in the future, we want to pull them into today. So that's the notion of accruing, is we're bringing it on board. We're recognizing it right now because that's the trigger event, the revenue expense. What's the journal entry to record the prepayment of a $3,000 prepayment? Now, this is a situation where we've got a deferral. Okay, so just make a little note of that. You've seen this before, but you probably never really thought about it as deferral. We pay cash in advance. Cash goes down. There's the credit, right? Debits make me happy. So this is a new asset. One asset goes down, a new asset goes up. We've seen this before. Why are we calling this a deferral? Well, this 3,000 cash will eventually end up as an expense, but not yet. Not until, in particular, it's been consumed, or for this particular case, time has gone by. So remember, deferral. What's the journal entry to record the consumption or use of 1 month's of prepaid rent? Well, again, in this, you've seen this also before where we said, well, if 1 month has gone by, or 1/3 times the 3,000, right, that gets us the $1,000 of prepaid rent has been consumed. When we consume an asset, the asset goes down. How do we show that consumption or vapor trail of an asset that's been consumed? We show it as an expense. There it is. What we've done here, as you can see, is we're recognizing expense now. This is the future. Okay? But in the past, today, in the previous example we talked about, this was like t equals 0. Now we're like one period in the future, t equals 1. So what is this notion of a deferral? Well, in this particular case, we paid cash, but we're going to defer or push expense recognition into the future. We use prepaid rent as kind of the intermediary account, kind of keep track of how much of this item we've actually been consuming and how much is left. And what the last question says is, how much in rent do we have left over? This 2,000 equals 2 months worth of rent left over. We have consumed 1/3 of it. We have 2,000 left over. So yeah, we paid out 3,000 cash, but we haven't consumed it all yet. So we want to be very careful about how we recognize this $3,000 that we paid as an expense only when it has actually been consumed. The prepaid rent is just like supplies or any type of prepaid account. We just use it to sort of temporarily hold any type of expenses that we want to push off in the future. That's why we call these deferrals. We're deferring or pushing the expense into the future. There's another type of deferral, but this one has to do with a liability. And it's important that you pay close attention to this one because it confuses a lot of people. Now, the account title, unearned revenue, has the word revenue in this account, but it is not, I repeat, not an expense account. The liability account is saying that, hey, on the income statement, we want to show revenue that has been earned. If it hasn't been earned, we want to show it on the balance sheet as a liability, unearned. What the heck does that mean, and how does that even arise? Well, it looks like this. Assume somebody gave us a deposit or some type of cash in advance prior to us performing a service, okay? We would recognize the cash. We get the cash, okay? But if we have not performed the service, if we get it prior to earning the revenue, we don't want to credit the revenue account. We want to credit the liability account for 3,000. So imagine it's like at t=1 in the future, right? That's the wedding day. And if I'm a church, I may ask for a down payment or a deposit today just to secure that particular date. Because remember, hey, I'm a business. If people want to use my services in the future and they say, hey, can you just book me down for our wedding 1 year from now? Well, if they cancel at the last minute, realize I could have potentially had somebody else take that spot for that particular day. So I may ask for people to give me cash up front just to make sure that they have committed to receiving my services in the future. If they're not willing to put down cash, they're probably not serious about maybe getting married. So ordinarily you might come across a situation where someone says, business will say, give me some cash in advance. The business is going to recognize the cash, but not yet recognize the revenue yet. So this is a liability. And realize what we're deferring is revenue. So we don't yet record that as revenue. We're going to push that off into the future. Okay. Now, assume that we've earned $1,000 of this unearned revenue. We've done 1/3 of the service, and maybe the wedding was kind of a bad idea. We only did a third. We only did a third of the ceremony. Now, let's just imagine that in this particular case, maybe we're a law firm, and somebody paid us a retainer of $3,000 a deposit. If we performed $1,000 worth of service on that deposit, we'll go ahead and move it from unearned revenue into actual revenue. And the way we do that is by simply debiting the unearned revenue and showing it as revenue on my income statement. Again, what did we defer? Well, this 3,000 wasn't earned yet, so we were deferring revenue into the future. This deferral account, this liability, unearned revenue, that's just kind of like a waste station. We're just putting it in there temporarily, and it represents how much cash we got that isn't really ours until we actually earn it. So we would probably want to earmark some of this cash in a separate type of a checking account. But at the end of the period, what do you see? Well, if we've earned 1,000, we'll show it over there as earned. Okay, we deferred it initially. This was a deferral, right? And now we've actually recognized a portion of it as earned. This is still deferred, meaning that I have this liability I owe of $2,000 to my customer. If I don't perform any more services for my customer, I have to pay this back in cash. So if for whatever reason I have to say, sorry, I can't do the other 2/3 of the business we agreed with, this $3,000, I better still have at least 2,000 of this to give back to the customer. Until I do that, until I perform the service or give the cash back, it shows up as unearned revenue liability. We're deferring, in this case, revenue. What type of an account is accumulated depreciation? What's its normal balance? So now we're moving into from deferrals into depreciation. And we're going to talk more about this in, I believe, chapter 8, 7 and 8, I think. So realize I'm just giving you kind of an introduction to depreciation. Accumulated depreciation is an account called a contra asset account because it acts contrary to assets. And what I mean by that is we know that asset accounts, like equipment, have a normal debit balance. Okay, but this is a particular account that we set up that pairs with that asset account to record actual any wear and tear of that equipment. We don't want to show it any type of theoretical wear and tear in the equipment account. We're going to set up this asset account called a contra asset to capture just the theoretical wear and tear of the equipment. Depreciation is still recorded as it happens. Like when you think about a car, the more we drive a car, the more that car depreciates. That still gets recorded. We just don't want to put any type of credit into the car's T account because it's just theoretical. So we set up this contrarian behaving asset account called a contra asset account called accumulated depreciation. What two distinguishing characteristics do contra accounts have? Well, contra accounts always have a companion account. So if we have equipment, we're going to have accumulated depreciation hyphen equipment. This is the companion, right? These guys are married, matched up, they're linked. If we have, say, building, then we're going to have accumulated depreciation for that building. Okay. If we have vehicles, we're going to have accumulated depreciation for vehicles. So they're tied together. And the normal balance of those accumulated depreciations is always going to be a normal credit balance. It's always going to act opposite or contrary to whatever the companion account is. So in this particular case, the accumulated depreciation is a contra asset account. So it acts contrary to what the normal asset account does. If we have a contra revenue account, it will have a normal debit balance. If we have a contra liability account, it will have a normal debit balance. The idea here is it just acts contrary, but it is always tied to a specific main account. How's the book value of the plant asset calculated? Well, it's going to be cost minus accumulated depreciation. This is the cost we paid for equipment. It's always showing in there. So if we credit cash, we would debit equipment. Okay? We leave that account alone. We don't adjust it. Hardly ever even touch this account. Any type of theoretical wear and tear is going to be showing up in the accumulated depreciation account. But realize, at the end of the period, we get this debit that we have to offset with this credit to determine net book value. That's why we call it net book value. It's netting the accumulated depreciation against the cost of an asset. We're not going to use the credit side of the equipment account. So if we purchase $3,000 of equipment for cash, what would we do? Plug in what you know. Cash went down and we got equipment. Now assume this thing depreciates evenly once per year for 3 years. Well, if 1 year goes by, we will recognize the wear and tear, i.e. the depreciation, the reduction of value of that asset account. It's theoretical. It's theoretical. We don't know for sure how much value we've lost or consumed of an asset like this. We're just making a guess. We are guessing $1,000 has been consumed. Okay? We know the value's gone down. That's why we call it depreciation. But we don't know how much. That's why we're putting it into the contra account. These guys are paired together. They almost act like one unit, okay? But we keep the cost separate from any type of depreciation that's been or wear and tear that has actually gone on in that asset. The expense still shows up We're just putting it into the accumulated depreciation account. What's net book value of that equipment after 1 year? Well, we just look at the cost minus accumulated depreciation. Right? We compare those two. Remember, these accounts are linked, right? They're married. So when we show this as an asset on our balance sheet, we're going to show $2,000 of net book value. It's kind of like, this account is sort of like a deferral account in the sense that, yeah, we paid cash and we're going to recognize it as an expense eventually in the future. But the reason why we call this one not a deferral is because, well, in this particular case, we don't know how accurate this expense is. So when it comes to supplies, that's a deferral account, but that's actual. We can see that. Same thing with prepaid rent. That's gone. What is a revenue that has been earned but not yet collected called? It's called accrued revenue. Therefore, what's an expense that's been incurred called but not yet paid? Accrued expense. Kind of basically what we're saying is we are accruing, we're recognizing. So if you see the word accrued, think recognized or recorded, or it needs to be recorded. If it hasn't been recorded, it needs to be recorded. If we see it in the books as an accrued revenue, it means we needed to recognize that it has been earned. If we see an expense on the books, we're just simply saying that we recognize it has been incurred. Whether or not cash has been received or cash has been paid, well, that's the second part of the story. Usually in these cases, it doesn't mean that cash has actually moved. If we're accruing revenue, it usually means we have an account receivable. If we're accruing expense, it usually means we have some type of payable account. Okay? When it comes to adjusting journal entries, we're not dealing with cash. When we sell $2,000 of services on account, by now you guys are probably sick of this phrase, we are selling $2,000 of services, meaning we're earned $2,000 of revenue. Okay, so we know right off the bat when we're selling or performing or doing something we promised to do for somebody, we are earning revenue. That should automatically think credit revenue. Okay, in this case, it's on account. What's the journal entry to record that? Not cash. Put it to the accounts receivable, and we credit service revenue because it's been earned. Okay? Often we've seen this before where it happens during the year or during the month. But here, realize this journal entry can also be an adjusting journal entry for things that we may have to estimate. Even if we estimate revenue, we don't know for sure. We haven't done the paperwork. We call some of our agents, our selling agents out in the field and say, how much in subscriptions have you sold? And they say, oh, I sold about, $10,000 worth. But I haven't sent you guys a paperwork yet. We'll just say, fine, we'll go ahead and record $10,000 of subscriptions you sold, but give me the accurate figure as soon as possible. We may have to make an estimate in the meantime. We may have to accrue, even though we don't have the specific amounts yet. Realize we're not affecting cash when we're doing these types of accrual entries. Okay, we're just acknowledging that there is some sort of revenue, and it's not going to be a debit to cash. When we do collect it, you've seen this before, we give the cash, accounts receivable goes down. So what's the point here? Revenue, cash. Okay, ultimately, whenever we have revenues, okay, we want to see them show up as a debit to cash. But if we don't get them, there's a timing difference between when we perform the service. That's the key triggering point. We did earn the revenue, but we haven't received the cash. We need a way station. We need something to sort of hold on or remember the fact that we've got money coming our way. We just haven't received it yet. So this is just an account we use to hold on to things and keep track of people who owe us money. Eventually, it will all come our way. When we accrue for any expense incurred, we must do what to that expense account? When you see the word expense incurred, automatically think debit. Always just think debit. Okay, if you see expense incurred, think debit expense account. If you see revenue earned, think credit revenue. Okay, Start off your journal entry with those things you know. Even if you don't know what the credit is, but you know the debit, start it off that way. You don't have to always start with debits. If you know that revenue's been earned, but you don't know what the debit is, that's okay. You can figure that out. You can make a pretty good guess. But start off with what you know. You see expense incurred, revenue earned, plug those in your journal entry so you get some momentum going on this. But again, in these type of cases, remember, these are adjusting journal entries we're talking about here. They don't affect cash. So if people have performed work for us, they're going to expect to get paid. In the meantime, we'll put it into a salaries payable, just temporarily. Why do we do that? Well, remember, the trigger was the fact that there was an expense. That's happened to us. It's been incurred. So whether or not it's been paid out in cash is really the question now. It's some type of payable liability account we may need to credit just temporarily until eventually we debit that and we credit the cash account. So there's a timing difference between cash moves and when expenses and revenues have to show up on our income statement. That's what we're doing here. So we're trying to figure out, hey, what kind of waste station or sort of placement bucket do we put these things until cash is actually settled out? In summary, I always recommend that you guys, from your book, when you're given some type of chart that sort of summarizes things, you write this down. So when you get a chance, go into your book and look at Exhibit 3.6, and they'll show you everything we just kind of talked about here. When it comes to the prepaid expenses, just think about, for instance, e.g., let's think about prepaid rent. Okay, cash moves first. This is T equals 0, and then eventually we reduce prepaid rent when the month is up. We record it as expense. We're pushing or deferring expense into the future. Same thing with revenue that we haven't earned yet. Record the liability here, and then defer the revenue into the future on the income statement. Okay, so these are the income statement effects over here. When it comes to accruals, we're showing the income statement effects at T equals 0. Okay, show those expenses and revenues right now, and then if we have to settle out later, settle in cash. Okay, these are always good charts, but make sure you can write them in a way that makes sense to you. We debit depreciation expense and credit accumulated depreciation, contra. This also shows up in one of your exhibits 3.7, and I just want to highlight this, that unlike supplies, okay, in the case of supplies, right, we have some supplies, okay, let's say we have $300 worth here in supplies, right? We start off the month with $300 of supplies. At the end of the month, we go in, we see we only have $200 left over, okay? What the hell has happened? Well, we consume some of those supplies, and we show it as supplies expense, okay? So just go ahead and put in 100 debit, 100 credit right there, okay? Some of it's been consumed. You can see it, right? You can look inside those are eyes. You can look inside the closet and see that, 100 has obviously disappeared. Assume that they've been consumed. Show it as an expense. But when it comes to depreciation, realize when you buy the car, okay, this is a truck, call it a truck, okay, or a Hummer. It's going this way. Okay, if that's a car, realize that when we buy the car, the vehicle, it's called a vehicle, okay, we buy it for, say, $20,000, okay. We drive it. Guess what? After a year, it's still there, right? Still exists. It hasn't disappeared. It's still there. So we know that the vehicle is, for all intents and purposes, hasn't changed. It hasn't disappeared. How do we recognize that the value has gone down? Well, that's why we use accumulated depreciation and depreciation expense. Okay, this is all the theoretical amount of wear and tear. Okay, supplies, we can see they disappear, but in the case of depreciation, it is just theoretical. Okay. And again, we'll see this again in the future. Just realize it's a contra asset account. That's something that usually ends up on the exam for you guys. After all AGs are recorded in the journal, posted to the ledger, we can begin to construct the what? The adjusted trial balance. Okay, the adjusted trial balance says, look, we had already recorded all of our T accounts for what happened during the period, but these are the AJEs, adjustments, that we needed to do because it's the end of the period and there are certain expenses that need to show up on our income statement, and there are certain revenues that need to show up on our income statement. So we did these adjustments, okay? We posted those. You can see in the summary in your book 3.9. When we posted those, we can see the effect. There's your depreciation, there's your income tax, supplies, salary expense, right? These are just the postings of the adjusting journal entries, right? These now what we can say is when we look at balances like, for instance, when we look at something like prepaid rent, the balance is $2,000. We can say this is okay. We look at something like supplies, we can say this is okay to report. We get receivables and say that's the appropriate balance. Okay, and notice how these have corresponding effects on the income statement, revenues and expenses. Okay, if we did not record these adjustments, revenues and expenses would be incorrect, potentially showing too little in liabilities and too much in assets. So that's why we have to do these adjusting journal entries. We don't want to mislead people when we file our financial statements. This looks like craziness, but just realize this is coming from your book 3-9. When we initially did our trial balance earlier from chapter 2, we took all the initial balances, we call those unadjusted balances, and we just pulled these right from the ledger. Okay. And the good thing about the trial balance is it shows us whether or not we captured things. And, it's possible that maybe we're still off by an amount, but as long as it's balancing at the bottom, chances are we captured all the effects from these transactions, and we have those in the ledger. Okay. This trial balance helps us figure out what has been done, whether or not we've done it relatively correct. Okay. But realize it's the adjustments. Okay. These are the effects of the AJEs. Okay, we're posting these all not just in the ledger accounts, we're also showing these things in the trial balance. So in the case of accounts receivable, where's that coming from? Well, what you're showing here on your trial balance is that initially accounts receivable, the unadjusted balance was $2,000. We had to make an accrual for another $300 to get the balance up to $2,500. And that's the case because when we look at the previous mess here, when you look, for instance, at, oh, come on, Kevin, accounts receivable here, you can see there's the 2,200, there's the AJE, and there's the OK balance. 2,200, 300, 2,500. 2,200, adjusting journal entry, 2,500. And we do this on all the accounts that have been adjusted. So there's in the case of supplies. Supplies start off with 700. Then we said in the ledger we consumed 300, so we have 400 left over. Where is that? Go to the supplies account. 700 is what we started with. We consumed 300. Now we have 400 left. And again, you can say, well, did we really, why did it go down? I don't know what that means. You can always go back to your adjusting journal entries in your journal. This is from your journal. And look for that particular tick mark and say, oh yeah, we had supplies used. That's why supplies was credited. And that's why I see it right there in the T account in the ledger. I can see, oh yeah, there's that credit right there. So yeah, that should be the new balance. And then you just double check to make sure on your trial balance, yep, this is the unadjusted, here was the adjustment, and that should be the balance that I report on my financial statements. So the journal, the ledger, and the trial balance, they all help us kind of keep all the transactions and the balances organized and help to make sure that we captured everything, even the things that we had to adjust certain balances. Why do we do it? Why do we put these adjustments? Why do we put these on the trial balance? Because these need to be inspected carefully. Usually we'll have a CEO or high-level manager just scan these just to make sure that all these adjustments look appropriate. If the manager wants to drill down and look at the T accounts and the journals, the manager can. Okay, but the adjustments just help us tell people, especially auditors, hey, our system showed this. Here are the necessary accruals, deferrals, and depreciation, and this is ultimately what you see on the financial statements. It just helps us keep track of everything. It's a neat process. Current assets. Okay, now that we have an adjusted trial balance, where are we going to pull these from? And pull these from the top. So, adjusted trial balance will list all the asset accounts at the top of the trial balance, but realize it's the current assets, the stuff we're going to use over the next year, that are the very, very top. Long-term assets are listed after current assets, before current liabilities. Here they are, long-term assets. So all the assets are going to be in the first section, and the assets are going to be before the liabilities. But we list current assets first, long-term second. Current liabilities, well, there's our long-term assets. Are going to be shown right there, current liabilities. If we do have any long-term liabilities, a long-term liability would be something like notes payable. If we had a balance, we would see it right down here, after the income tax payable. So these are all going to be paid within 1 year. The adjusted trial balance shows a balance of ending retained earnings. This is false. This is a key thing. You don't want to make a mistake on this on the exam or on the homework. What we see on the trial balance is retained earnings. There's the credit balance. That's the starting point. Okay, we're going to use this information to help us do our statement of retained earnings. And we'll talk about in 3.5 how the closing process works. Dividends balance on the adjusted trial balance appears on the balance sheet. No, it does not. Remember that dividends ultimately show up on the statement of retained earnings, which is what they're showing you in this exhibit from your book. So when you're looking at retained earnings and the dividends accounts, realize those items should appear on your statement of retained earnings, but they don't yet show up on the balance sheet. Think about using the trial balance as starting from the bottom and then working your way up to the top. So, income statement, start at the bottom. Take your revenues, plug them there. Take all your expenses, plug them in there. Do your little calculations. You have a chance to do this on your homework. Statement of retained earnings. The balances from the trial balance. Okay. There's your beginning retained earnings. There's your dividends. You pull in net income from where? The income statement. Okay. So you need to do the income statement first. If you don't do the income statement first, you won't know what to put in for your net income. So do the income statement first. After you do the statement of retained earnings, then your ending retained earnings balance can be put into your balance sheet. And all the other account balances from your trial balance, you put in there. Just make sure that you put in first your ending retained earnings from your statement of retained earnings. Put that in first, and then start pulling in from your adjusted trial balance all the other asset, liability, and equity accounts. All right, I'm going to stop there because that's a lot. I want to leave the closing journal entry process for Monday. In the meantime, you got questions, send them my way.